Good morning, this is Kim, and right now this is going to be the first of two videos. I want to introduce you to to the investment pyramid. So, of course, it has the pyramid shape and it has four different levels. And on the left-hand side, it has what I'll call a risk continuum. So over here, this is our measure of risk. So up here would be high risk, and down here would be very low, no risk. So if we think about all the different types of investments, at the very lowest level down here on the bottom foundation of the pyramid, we have cash. Cash or what I'll call cash equivalents. Okay? And that's our topic really for this week. So it's an important topic, cash equivalents. They serve as the foundation of our investments. We need to have money at this level for a variety of reasons before we start making investments at these other levels. So let's talk about this level right here, because this will be our conversation for next week. And this is going to be bonds. Different types of treasury bonds, corporate bonds, muni bonds, etc. And when we move from here to here or up at any other level, we are becoming investors. We are putting our money into securities. So this is bonds, and then up here, stocks. And then up here would be more risk. Again, we're talking about here being over here on the risk scale. So this might be international. International being more risky than domestic stock because we don't know a lot about an international country that we might be investing in. We don't live there, so that becomes higher risk for us. Also, things up at the top might be types of funds called sector. Sector funds would be healthcare, technology specifically, energy, that really focus on a specific sector. Again, if we're not an expert in that sector, then investing in that area becomes more risky for us. Now, within these, you're probably wondering, or maybe not, where are mutual funds and exchange traded funds? And they're really on all levels here. So we have mutual funds and ETFs, which if you don't know these, you will soon. Next week, bonds and stocks. The week after that, we're going to focus on stocks and markets. And then we're going to focus on mutual funds and ETFs. So lots to cover here as you move from a saver, this is a saver, to an investor all the way up. Now, where should you have your investments given this risk profile over here? So, for example, if you keep all your money in cash, then you will have a low risk portfolio. However, low risk, just so you know, low risk equals, again, low return. And remember, return is our percent. That's what we're trying to make. We want to grow the asset side of our balance sheet by making good choices, saving and investing. If you are willing to accept a bit more risk, you can add bonds to your portfolio, even more, stocks, and then finally up here in sector international or other things that we don't understand. This might be also investing in currency. Really, the overall best portfolio would have money at all these levels. You would have cash as a base or your foundation. You would have some percentage of bonds in your portfolio, some percentage of stocks, and some percentage of sector or international. So that's a nice way to think of how you would invest. And eventually, we're going to have an exercise where we really think about ourselves and our risk profile, and we come up with sort of the percentages that we want in all these categories. And maybe another category could even be real estate. Okay, that could also be part of our investment portfolio. So I want you to understand this in terms of risk. And now I specifically want to focus on this, cash and cash equivalents. So what are they? What does that mean? First of all, they come in 3 flavors. So we have 3 flavors here. We have bank products, okay? Bank products would include our savings account, a money market account, and a CD. We have government, federal government. This would be Series EE bonds and Series I bonds. And then lastly, we have what I'll call investment company. An investment company could be Schwab, Fidelity, Vanguard. All of these have a cash equivalent account, and it's called a money market mutual fund, similar to a money market account, but only offered in an investment company. So now that we understand the pyramid, and we know that our cash equivalents, which we're studying this week, come in 3 different forms, let's start to talk about these in more depth. So I'm going to start over here with just bank products. And you know what a savings is. Most of you have a savings. Many of you might have a money market account. And then there's the CD. CD stands for certificate of deposit. So a savings, you put your money in and you can take it out anytime you want. Okay, savings, that's what a savings account is. A money market account is more restrictive. And what I mean by more restrictive is that your bank may say you have to keep a minimum balance. They might limit your withdrawals. So in some way, a money market account is generally a bit more restrictive than a traditional savings. A CD, again, a bank product. A CD is something you buy, so you buy this for a fixed period. For example, 1 year. I'm going to buy a 1-year CD. And what that means is I'm going to give the bank some money and they're going to hold on to it for 1 year. And over that period, I'm going to earn interest. And then after the 1 year is up, they're going to give me my money back. So this is the most restrictive cash equivalent from a bank. Because if you take that money out within the year, you pay a penalty and you forfeit all the interest. So it's more restrictive than a money market account. Okay, so let's talk about then generally returns you should receive from these different types. So a savings account is the safest. You can get your money out anytime. So its annual interest rate is very low. A money market account, given that it's more restrictive, has a typically slightly higher interest rate than a savings. So it would be higher interest, okay? Anytime you have more risk associated, so the risk that you can't get to your money, the bank has to pay you more for those types of restrictions. So it's higher interest than a typical savings. And a CD would then be the highest because again, bank, you're giving your money away for a year. And since you don't have access to that money, you want a higher interest rate in return. So those are the 3 bank products. Another feature of bank products is that they're FDIC insured. Okay? So that means try to write neater here. If something were to happen to the bank and the bank went under, your accounts would be covered up to $250,000. So that's quite a lot. And most of us right now are not going to have anywhere near that kind of money in any of these accounts. So those are the three bank products. So remember, we also have government. Okay? And the government has two products we're going to look at. It has these Series EE savings bonds, and some of you probably have one of these. A long time ago, they were really popular. You could go to a bank and you could buy this piece of paper, and it was a Series EE savings bond, and you bought it for half of whatever the face value is. So if it had 50 on it, it was worth $50. You only paid $25 for it, and then the interest accumulated over time, over a period of 30 years, and then you could cash it out and get your $50. So these are still around. However, they're purchased online now, and they're a little bit different. So we'll go to a website in the next video and look at these. And the other type is I, and the I stands for inflation. So an I bond is a type of federal government bond that adjusts the annual interest based on the inflation rate. And we know what inflation is, the general increase in prices. So, for example, here, if inflation is increasing, then the I bond interest will also increase. So it's kind of like a hedge. It's protection against inflation. So if inflation goes up, your I bond interest rate is going to go up. On the other hand, Series EE, these just have a fixed rate. So they're not going to adjust like the I bond. Okay? Now the next type of, or the last type of product is by an investment company. And it's really a money market mutual fund. That's what they call it. And it's got a fund. So instead of a money market account from a bank, it's a money market fund from an investment company. And the big difference between these, it's fully liquid. It's like a savings account. So you can get your money anytime. And the next thing is that it is not FDIC insured. That's the difference between this account and a bank account. It's not insured by the federal government, but it has a useful purpose. I think of it as a temporary place to put my cash when I'm waiting to make an investment decision. So I'll hold cash in a money market mutual fund, gain a little bit of interest until I'm ready to make an investment. So that's how I use a money market mutual fund. If I'm just planning on saving, or keeping some money aside in cash, I wouldn't put it there. Instead, I would put it in a different type of bank, which we're going to talk about. On your homework, going back up here, I ask you, why should we have a certain amount of money in cash and cash equivalents? So the big question is, why? Why this? And the reasons to me are pretty obvious. I don't know about you, but I have a life where stuff happens that I didn't plan for. So I could have something. So in my stuff that happens, I could have a car repair. I could have a pet bill. I could have a wedding. So I have to buy a gift or an event where I have to buy clothes. This is stuff that I don't regularly budget for, but it does happen in my life. So when things like this happen, I can take money out of my, what I'll call emergency fund, and use it to pay for things like this. And then I continually replenish this account. So I always have this money available. Because what happens if you don't have this money available is you have to use your credit card. which costs you and reduces your net worth. You have to maybe borrow money from someone else, or you have to take money out of an investment to pay for these types of things. And that's what we want to avoid. We don't want to have to go outside of our emergency fund to cover these types of things that happen in everybody's life. So it's important, critical, that you become a saver and start putting aside some money in some sort of cash equivalent. And again, we've talked about these cash equivalents, and now in the next video, we're going to go and look at rates. So signing out for now. Thank you.